Good morning, Ryan.
Good morning, Tony. How are you?
Fantastic.
Great. So, is it just me and you, or do we have other participants?
We have some people listening in to our conversation right now.
Ugh, man, always makes me nervous. What's our topic du jour?
I thought we'd touch on either wine or real estate.
Wine or real estate? Two things I know nothing about. I
I
think
just realized I'm drinking out of a travel wine mug, and I want to reassure everyone this is coffee and not wine this morning. So
um, I do not feel reassured. So
I'm already getting some responses.
What's that, Tony?
I'm already getting some responses that are calling me a liar, which I guess I've earned a reputation.
Probably is the goatee. You know, it's funny. I was reading an article recently that despite all the disruptions with COVID and everything going on with the economy, that they're still selling razors at Walgreens. So, no disruptions in the razor supply stream. So I was just curious what you've been.
Are you trying to get at something?
Hey Tony, I'm gonna step away for 1 second because I realized I left my water bottle over on the other counter there.
Sounds great. Hi everybody. If you're just joining us, we're going to get started here in just a couple of minutes. And please feel free to use the Q&A button at the bottom of your screen for any questions. We'll make some opening comments and share some details with all of you that have emerged over the last week or so since we were together. And then we will do some Q&A as we've done in the past. So we'll give it another minute or two to let people join us.
Do you have any interesting questions for me, Tony?
Ryan, I'd like to get your take on the discussion about Major League Baseball starting their season entirely in Arizona.
Wow. Major League Baseball. That's not even in my top 73 items to discuss or research. I will say that I was aware of that. The reason why I was aware of it was not because I pay attention to Major League Baseball news. I probably couldn't recite 7 Major League Baseball players right now. But I try to keep up with the Phoenix news. And I think I saw on the Phoenix Business Journal page maybe yesterday that they were talking about doing all of the games in Arizona between Chase Field, where the Diamondbacks play, and I think they have 11 other fields with their spring training facilities. So I think that's a great idea, except for that it would not be socially distanced, and it would be really, really warm.
Really, really warm.
Okay, question for you.
Yes, please.
Do you prefer Phoenix in July or Detroit in February?
Oh, gosh. Oh, man. Detroit in February.
What? Oh, my God.
I hate to say it. Here's my rationale on this, okay? We live in a society where it's only acceptable to remove so much clothing, and you can put a lot of clothes on and stay nice and warm in Detroit, but you cannot get cool in July in Arizona.
I'm pretty sure that those societal rules I might be breaking from time to time. I think
I know that comes as a surprise to you, but it is there are some norms there.
Detroit in February sounds so painful, and I actually have experienced it on many occasions. we're going to talk about real estate today, and I happen to have a little bit of real estate out in the Detroit area, and have been there several times in February, and on no occasion how I truly enjoyed the climate. Though I may have enjoyed the company of the people I was with, I may have enjoyed the thought exercise of the real estate that was there, the weather, no grass.
Well, I think on that note, Ryan, we should dive in. What do you think?
I'm ready to dive.
All right. Well, good morning, everybody. Welcome to the Atlas Real Estate Market Update webinar. One of the things that I'm trying to master these days is looking at the webcam camera instead of the screen. And I do a poor job of that, so I apologize. And I don't think I necessarily want to get good at that. I would much rather that we were all together somewhere right now enjoying a cup of coffee and talking about real estate, but we're going to make the best of it virtually. So thanks for joining us. Joined by Ryan Boykin, co-founder of Atlas Real Estate, and we're going to make some opening comments here and then open up for Q&A. Feel free to use the Q&A button at the bottom of the Zoom screen. Really easy way to get your questions in, and we'll try to get through every question that we can. I'm going to go ahead and kick us off with the announcement of a new position that we created at Atlas in over the last couple of weeks, and we're pretty excited about this. We want to make sure that it is known far and wide that this person is in this role to assist our residents. So we created a role called the Resident Resource Manager, and our property management leadership team, our team in property management is led by Nick Mertens, who many of you know, Ryan Dennison, Rebecca Slaughter, our regional managers in Colorado, and then Mallory Johnson leads our team in Arizona. They put their heads together and said, how can we serve our residents in really tangible ways right now? And what came from that was the role of Resident Resource Manager. And that role is filled by Erica Ojeda Louvier. Erica has a tremendous background in property management and in the nonprofit world as well, has been with our company now and served in multiple business lines, so understands our company really well. And Erica is just a talented, capable, bilingual person who is able to serve our residents so well right now. And she is booking up quickly. And I want to explain that role a little bit. So Erica will not replace a property manager. She will not engage in lease negotiation or payment plans or things like that. Her role is entirely to support the resident, to guide them through the resources that are available to them if they've been impacted by COVID-19, to help them understand unemployment, to help them understand grants that are available in different municipalities, different charities, to help them explore employment opportunities. Even though unemployment is climbing rapidly in our country, there are companies and organizations that are hiring right now across the Front Range of Colorado and in Arizona. So we're really excited to have Erica in that role. We're communicating that broadly with every resident that we serve. They are actively reaching out to her now, and she is busy taking those calls and providing coaching and guidance and insight to our residents so that they can be more successful through a difficult time. So we're excited to announce that we will send out more information on that. That was in a market update that we sent earlier this week, but it was a short kind of introduction to that role. We'll send some more info out around specifically what we're seeing to our owners, and we're always open to your input on that. So this is an idea that several of our owners also shared back to us saying, hey, have you thought about someone in this role as we were working on that? And then it's just so great to see the collaboration that came from that and to have Erica in that role today. Ryan, I'm going to hand it off to you.
Awesome. Thank you, Tony. One quick logistical comment. If my audio or Tony's audio is coming across choppy or unclear, please just mention that in the chat box of this webinar so that we can be aware of that and change pattern a little bit. So the purpose of this call is to understand the current environment and begin to look forward a little bit. In our prior two calls, I think that we've been really focused on looking past and looking at the current day. Increasingly, we'll probably try to look a little bit towards the future and find something probably small stage. So what this all means for real estate. I'll usually recap who Atlas Real Estate is. Atlas is a real estate services company. We have 4 distinct departments. The first one is that we help people with property management. We manage about 3,200 homes in Colorado and Phoenix. The second one is that we have a robust brokerage that focuses on helping people buy investment properties, as well as helping people buy their homes or sell their homes. The third one is a partnership with Zillow Offers, helping them to purchase homes Zillow like to purchase and sell in the Colorado market. And the fourth one is our institutional business, wherein we help big institutions purchase single-family homes for rent and like to hold those portfolios for the long term. So,
hey, Ryan, we are getting some feedback that you are a little choppy.
Okay.
In that spot.
I'm going to switch to phone audio, and so this will just be a brief interruption. While I do that, Tony, I want to share with the folks on the line how our rent collections looked this month versus prior months, and give a little bit of historical context on that. I'll be on here in a moment.
Awesome, thank you. So we've been. Hey Ryan, can you mute? Actually, I can. Ryan,
Tony?
Mute your laptop. Can you mute your laptop so that we don't have that feedback? Your dial. Cool. So I wanted to hit on real quick what we're seeing for rent collections, and this is important. It's something we're paying very close attention to right now and tracking very closely. Normally at this point in the month, we see our rent collections at anywhere between 85 to 87% of our residents have paid their rent. That number climbs from the 5th to the 15th, and then by the end of the month, we typically end up somewhere around 98 to 99% collected. And so far this month, what we have seen is a drop off in collection of about 6 percentage points. So as of last night, when we pulled this data, we were sitting at 82% versus an 88% collected in March. 87% collected in February. Just to kind of look at that run rate, 89% collected in January through the 9th of the month. So we anticipated that we would see that drop off number. So we're pleased to see 82%, and we'll continue to monitor that throughout the month. We don't believe that we'll see the normal climb through the rest of the month that we would normally see. Toward 98%, and we do believe that it's likely we'll see a larger impact with May receivables over April receivables. So Ryan, I'm going to hand it back to you, let you make some comments on that too.
Great. Hopefully my audio is a little bit better. Tony, yours is a little bit choppy as well, but it's hanging in there. I think that as I look at those numbers, it's quite a bit better than I would have guessed. I sort of thought that this month we might see a reduction in collections to the tune of 10 to 20% from the historic norm as of this date. Tony gave the commentary of where we sit. We'll see where we end up by the end of the month. As he said, we historically have collected about 98.5 to 99% of our rents every single month by the end of the month. So we'll comment on that again as time goes by. I think that the other thing that occurs to me as I look at this and I look at my real estate portfolio, and as we advise to others out there, is how do we stress test our portfolios? And this is a concept that was brought to our attention through Michael Hills and Jim Doolittle, who work in our investment brokerage side of the business. And basically the concept here is we don't know exactly what to look forward to in the future, but we do know that things are going to be a little bit tougher than the past. And so how do we stress test our real estate holdings, and how do those move up and back and based on the rents? And so at Atlas recently, just in the last few days, we developed a model, a financial model, wherein we can provide for clients the tool of stress testing their real estate portfolio. What happens if your rents are only 90% collected, 80% collected, 50% collected? And what do you need to do to plan for your cash reserves in that scenario? And so I can show maybe in a little bit here, if there's a desire from the audience, what that stress test model looks like and how it works, just as a quick test case. But that's one of the new tools that we've developed to look forward and try to understand where our portfolios are strong and where our portfolios need more attention, and frankly, where we need more cash reserves. And I've talked a lot about cash reserves in the last two conversations that we've had and how important they are. And I think that that's a guidance tool that we've developed. So those are our collections, those are stress tests. The other thing that I wanted to mention before taking open Q&A, and then I'll shut up for a quick second, is we've talked in the past about what the Atlas investment thesis is, and it's primarily built on three categories that we look towards to determine whether or not we're going to really dive in and decide if a piece of real estate is one that we should purchase or not. And those three layers of our Atlas investment thesis, and they actually are in chronological order. First is that we will only purchase real estate that we believe is located in a 20-year market. So the very simple statement that we could make today, that we could also make yesterday before coronavirus set in, is the real estate that we buy in Denver, for example, today, do we believe that the value of that real estate over a 20-year period, so the long-term period, will be worth more or will it be worth less? Very simple comment. And even today, I believe, and even 3 months ago, I believe that the real estate that we buy in Denver will be worth more over the next 20 years than it will be today. If we don't believe that wholeheartedly, then we won't purchase in that market. How has coronavirus changed that? I don't think coronavirus has changed it. Denver still is a place that I believe we should be buying investment real estate. It still is a place that I believe will be a strong economic foundational source for the next 20 years. I believe that for Fort Collins and Colorado Springs and Phoenix as well. So we still check the box, in my opinion, on our 20-year investment outlook over the long term in our thesis. The second thing that we want to look at is cash flow. So the assets that we buy today, do they have enough cash flow to get us to the 20-year period? And this is really interesting right now, because if you've just recently purchased a piece of real estate, an investment piece of real estate, and my most recent purchase was maybe about a month ago, so pretty recent, I've had to ask myself, did my financial model on that piece of real estate adequately predict what the cash flow is today? Well, clearly not, because I was using yesterday's information. But the good news is that I had cash flow, and I still had enough cash flow that with a reduction in rent and a compression and higher vacancy, that I'm going to be able to withstand this difficult time with coronavirus. And I'm going to be able to be through the downturn to see the upside that will happen over the next 20 years. And that's why that cash flow is so important. And then the final component that we look at is the path of development of our city. Now, when I talk about path of development, that's really sort of the story around the piece of real estate that we're owning. And I think that the story, as it relates to the submarkets in each of our cities that we participate in, is very different today than it was yesterday. And this is perhaps the greatest place that our Atlas investment thesis will meld and shift and change in the new environment versus the last environment. And I'll just pull what I think is low-hanging fruit to give this example. Maybe real estate in Aurora North right now will be more attractive because it's centered around the Anschutz Medical Center. And the Anschutz Medical Center is going to have a lot going on there over the next year, 2 years with what's happening with coronavirus. And so maybe real estate in that corridor may be viewed as a higher appreciation opportunity than real estate in other corridors. And I'll pick on one that has been robust and amazing over the last 5-7 years, and that's the Rhino corridor up through the stock exchange and the stock show area. All that area, the Brighton Boulevard corridor has been raging with development over the last 5 years. Well, given what's going on in our environment today, are we more likely or less likely to see development continue at the pace that it's been continuing at? In my opinion, development is going to come to a halt in the near term, or it's going to significantly slow down. Now, will that mean that the Brighton corridor will have less of an appreciation story for it? Maybe, maybe not. And I'm not making the conclusion that it will or it will not. But I do think that our current market environment is asking me, is requiring me to ask the question, how does my appreciation story, my path of development story change now versus what my opinion of it was just 2 months ago? So that's a little bit about the Atlas investment thesis. It's a little bit about how we look towards the future on what the market is telling us about how we should invest our dollars. The key on all of this is that we are a long-term oriented company. If you're looking to come into real estate and make a quick buck, that's a tough thing for us to do for you. There may be other better people to work with out there on that. For us, it's a long-term story. What does a savings account look like as it relates to investment real estate? So I'll pause there. Tony, have we had any interesting, unique questions that we should jump into, or I can keep on rattling off more thoughts?
Yeah, so just a reminder to put your questions in at the bottom of the page. Just click on the Q&A button and give you the opportunity to type in a question. We have a couple questions, Ryan, and they're kind of centering around, this question that everybody's asking us. Should I buy real estate right now in Colorado? And based on recent sales, do we foresee a shift toward a buyer's market? And Colorado's definitely been a seller's market for a long time. Is that going to change in the months ahead?
This is the $1,000,000 question. I think it's dangerous in some regard to try and pull out the crystal ball on this. Of course, I'm going to comment on it because I'm not going to shy away from providing an opinion. I think that, first off, let's talk about the market today, right now. We're still seeing a lot of activity in home purchases and home sales in the sort of affordable category for Denver, which is less than $400,000. As you grow from that purchase price, that really begins to change the story a little bit. And I think that you just have a lot of uncertainty and nervousness in the market. So a lot of sellers have pulled their listings. The number of active listings on the market is quickly changing. And certainly the number of showings and the activity around that is plummeting right now. That's expected to continue to be quite low in terms of showings because of the shelter-in-place order. But as it relates to buying real estate, my perspective on this is that right now I'm being patient. If I have a distinct need to buy real estate right now, I'm going to take that into consideration. I'm going to evaluate my personal needs and my personal goals, and I'm probably going to go out and I'm going to buy real estate because I have a distinct need. That distinct need might be that I'm looking for a home to live in. It may be that I am in a 1031 exchange and I have a clock ticking and I don't want to pay 20% to the government. That's a very big need and consideration. I think that if I don't have that distinct driver that's forcing me into the market right now, I'm looking at this environment and I'm saying, I'm just going to be a little bit patient. Doesn't mean that I'm not still looking for opportunities. And I personally, in the last 5 days, have looked at a couple pieces of investment in real estate and said, wow, this is looking a little bit more attractive than it was a month ago. I think that I can get a discount on this price. And maybe I'm not in a 6% cap rate buying environment. Maybe I'm in a 6.5 cap or a 7 cap. And I won't go into what a cap rate is for those that don't know, but essentially I'm saying that maybe the return on investment promise looks stronger. Now against that, the certainty of the return on investment looks weaker because I really don't know what my rents are going to be. And I really don't know what my vacancy is going to be. And that's why I want to be patient. Do I think that we're going into a buyer's market? Yes, I do. I think that we're going to see a moment in time over the next 6 to 12, maybe 18 months, where the buyer is going to have more power than they have in the last several years in the Denver and Phoenix markets. Will that mean that we're going to have a fire sale and a discount on real estate like we did in 2008 to 2010? I have no idea. My inclination is probably not, particularly with the way that we're responding to this issue from a societal standpoint. But I'd like to be ready to capture some of those opportunities. And frankly, maybe it means that on my cash flow, instead of getting a 10% annual return on equity, I'm going to get a 12% or a 14% return on equity. That's not a giant move to the north, but it's meaningful. And if you do that over 20 years, it has a big impact. And again, I'm thinking the long term. So I'm going to cost dollar average in to some of my purchases here.
Ryan, what are your thoughts on how the moratorium on evictions, the certainly unprecedented forbearance opportunity for homeowners. How does that impact the market more broadly? Does it create a shadow inventory? Does it create less visibility into what's actually happening in the housing market?
It absolutely creates less visibility as to what's happening in the housing market. It absolutely takes a tool away from property management and investors and even banks in terms of the tool of accountability. And I think it's very important as we're in this environment that we don't lose accountability from a societal standpoint. We saw this happen a little bit in the Great Recession years of 2008 to 2012. People lost the accountability or sort of the social requirement that you don't give your home back to the bank, that it's not okay socially to give your home back to the bank. And I think that's an important institution or thought process of American society, that if you say you're going to pay something, you pay it. And I do have concern with some of what's going on right now, that we're eroding the value of, I told you I'm going to do it, and I'm going to kill myself trying to get it done. That's actually a core value of Atlas Real Estate. When we commit to doing something, it doesn't mean that every single time we can nail it and actually follow through and do it, because there's so many things happening, but we will destroy ourselves trying to follow through on our commitment. And I hope that what's happening with the evictions and the moratoriums and forbearance on mortgages doesn't mean that people take this as an opportunity to have a free roll, because if they do, frankly, American society would crumble. If you can pay your bill, you got to pay your bill. We're not moving to a socialist society, and some of the things that are happening right now are, frankly, big movements to have the federal government support all people. I'm not saying that's socialism by any stretch, but it's not the capitalist nature that our society has been built on. And so it's good reason to step back and say, okay, psychologically, what does this mean to how a consumer or a buyer or a renter is going to approach this question? Psychologically, what does it mean to me as an investor? And I do think that it will cause for less certainty and clarity in the market. Will it allow for a new level of shadow inventory? If it only happens for 3 or 4 months, my opinion is no. But if we continue to have people, give people the opportunity to not pay their rents, or people the opportunity to not pay their mortgage, then yes, eventually that will create shadow inventory. And that plays into the prior question, where over time, that's going to build more and more of a buyer's market, and it's going to give less certainty as to the actual value of the real estate, because there's latent supply that we are unaware of that is going to hinder the market when it comes onto the market, thereby driving pricing.
Ryan, along that same vein a little bit, what are your thoughts on the vacation markets, particularly in mountain communities? Do you anticipate a significant impact to those values over the next 12 months?
I'm going to comment not just on vacation markets, but on all luxury product lines. When economic times are strong, everybody rushes to a luxury product line. And the reason for that is, 1, the profit margins oftentimes are strong, and 2, it's sexy and fun. Guess what Atlas Real Estate is? We're just the common Joe out there. We're dealing with people that need a home to rent. And in most cases, the home that you need to rent is, a 2-bedroom for $1,200 and a 3-bedroom for $1,600. It's just a basic need. And right now, I look at economic times that are going to put pressure on different elements of our economy. And without fail, luxury lines and high-end price items are going to be severely compressed. And the need-based items are going to be supported. If you're in the grocery store business right now, that's need-based items. You're kicking butt. Your sales are up 30, 40%. Now, of course, part of that is the restaurants don't exist. But even if they did exist, people aren't going out and spending $100 a head on their meal. They're going and they're staying home and they're cooking their chicken on the grill. Vacation homes and Airbnbs and these second home markets are going to have a tougher time. That I feel quite certain of. If I'm in the market to buy a second home, if I'm in the market to buy my future retirement home in North Scottsdale, this might be a time to look at that. This might be a time where the buyer's market is a little bit stronger coming into it. Now, it's going to depend on how long this problem sets in economically. If this is a short-term blip and in 2 months we're back to normal and the recovery curve is a strict V, then those markets aren't going to be hit very much, because generally speaking, luxury real estate correlates to an owner that has more reserves through which they can withstand economic pain, okay? But if this sets in for 6 months or 12 months, those reserves are wiped down, and that means that that real estate is going to be compressed.
It's good. Ryan, what strategies, maneuvers are you considering right now to prepare for the post-corona real estate market?
Such an interesting mix. 2 days ago, 3 days ago, I was working and I was having the most difficult time focusing on both very, very big problems and decisions that I had to make, as well as pretty mundane tasks. And I couldn't figure out why I couldn't get into flow. Usually I wake up in the morning, 6 a.m., I'm in front of my computer and I am charging and I can go all day and there's no slowdown. And what I realized was that I was battling two very conflicting notions. On the one side, I'm in a protectionary mode, trying to say, how do I wade my way through this if I have 10 restaurateur tenants that go out of business? If I have residential real estate renters and only 75% of them can pay their rent? This is very protectionary. It's holding, it's careful, okay? On the other side, I have opportunity. There will be opportunity that comes from this difficulty, tons of it. I don't know where it's going to be, and I'm not totally certain it's going to be in real estate yet, but I'm just racing in my mind. What about this? What about this? What about this? And being an entrepreneur and having an amazing team within Atlas, I'm thinking about other opportunities that will percolate for Atlas and even outside of Atlas, and how I might be positioned to take advantage of them. Well, on the one side, I'm being motivated by fear, the protectionary side. On the other side, I'm being motivated by opportunity, and frankly, opportunity correlates back to love. So those were the two things that were fighting inside my head until I got to a point that I said, okay, I got to understand how to protect and how to save this foundation. Then once I've done that, I can begin to have the second conversation. And so I'm not even able to say, what am I doing with the opportunity yet? Because I'm still living in the ecosystem of today of making sure that my home is healthy. And in order for me to make sure that my home is healthy, I need to make sure that my revenues are in place. That's the stress test that I talked about. How much will my revenues go down, my rents go down? I need to make sure that I'm controlling my expenses. And there are many expenses that we can control. The mortgage, we can control to some degree by deferring payments. Other expenses like maintenance and capital expenditure deferral, and what I'm doing with my, my taxes and deferring my property tax payments, all these expenses I'm trying to manage. I'm also managing my cash reserves. And the cash reserves, if I have enough of those, give me very high confidence on the stability of my house, of my foundation. Also, if I have enough cash reserves, it means that I have cash reserves that can lead to the opportunity. So I'm looking at my revenues, I'm looking at my expenses, I'm looking at how much money I'm gonna have left at the end of the day, I'm looking at how much I need to supplement that money with my cash reserves. If I don't have enough, I'm trying to find new places to get cash reserves, like a line of credits or other things that I might be able to sell to create liquidity. And if all that sounds true, then I'm gonna start looking at the opportunity. And on the opportunity side, maybe I only have cash of $100,000 or $10,000 or $1,000. Well, if I wanna take opportunity, that's going to dictate how much opportunity I can really leverage and go after. And I also have to look at that banks may not be lending 6 months from now. I do think we're going to see a significant retrenchment in the liquidity, the tightening of the credit markets, okay? And so that's going to really guide what opportunity looks like. I'm really not focusing on it too much because there's so many variables that I can't determine quite yet.
That's great. I'm going to switch gears for just a minute, and then we're going to come back to some more discussion about what retirement looks like in light of this. So, but before we go there, Ryan, just a really practical question. How is Atlas handling and working with residents that aren't going to be able to pay rent over the next 2 to 4 months?
You have to work with them. You got to be their teammate. There's no question about it. We can't take them through an eviction, even if that was, well, excuse me, we can't take them through an eviction because it's not allowed. And even if evictions were allowed, you need to ask yourself if you're going from the frying pan into the fire. You must work with your renters right now. If you don't, you're probably going to be in a situation where you're going to have higher vacancy in your real estate portfolio. Most folks that buy rental real estate outside of the Atlas ecosystem probably couldn't answer this question. The question is, what is the greatest cost of owning rental real estate? And people say your mortgage. People say maintenance. People say property taxes, who knows? The greatest cost is vacancy. In good times, it's vacancy. In bad times, it's a really vacancy. We need to protect against vacancy. So for those folks that can't pay their rent for 2 to 4 months, the first question that I want to know is I want to understand fundamentally where they're coming from. Did they lose their job completely? Did they go from a 2 household income to a 1 household income or a 0 household income? Are they in an industry where it's likely that they're going to regain their employment quickly? Or are they in one where they've lost their job and they're out of it for a long period of time? Once I understand those variables, I can then ask them to be a partner with me and come up with a plan for what they can pay so that it shows that they're a part of this program, that they're vested in trying to do their part in paying their rent and be a good consumer of our product being our services as a property management company and the real estate that they're renting. If they're not going to have that attitude, then I must have a little bit more of a strict response because I understand that I am not one of their priorities. And frankly, a lot of renters, and this is in good times and bad times, will say, you know, I have a little bit of money and I'm paying for my cell phone bill and I'm paying for my kid to you know, have a new toy. And I'm saying, geez, where does housing fit in the need of your home? I want to know that it's at the top. It's up there with food and other basic health needs. So if that attitude is consistent, then I'm definitely going to work with them. I'm going to work on payment plans. I may take a haircut on some of those payment plans because I may not be able to recover all of the funds, but I'm keeping myself in the game. I don't want to be in a situation where I go from I'm making a lot of revenue to I'm making none and I'm literally out of the game because I can't pay my bills.
That's good. So, Ryan, if I'm nearing retirement and I'm looking at a stock portfolio that I have spent lots of years accumulating, and now I'm down 20%, maybe 30%, maybe I wasn't balanced in a good way, and I took the whole hit that the stock market took. Can real estate help?
Real estate can absolutely help. I'm not a retirement planner, but I do use real estate for my long-term savings device, for my retirement savings device, and I think a lot of people within Atlas would agree with that statement. One of the reasons why I love real estate versus the stock market is that real estate has cash flow and income. If you own a stock and the value of the Dow was at 30,000, and I think today it's at 23.5, the only thing that you can point to as to the value of your stock is basically the price. It was at 30, now it's at 23. So there's my, what is that, a 25% haircut or so. You can't point to robust income as a dictator, an indicator, I should say, of what the value of that holding is. You know, stocks might have 1 or 2% in dividends. Real estate is going to put you in the 8 to 12% based on what you buy yesterday. Let's not say today because we don't know what it looks like yet. But based on what you would have bought in February or January of this year, it's 8 to 12% return on your equity investment. So that's a really big deal. And the reason why it is because if you're using the stock market or real estate to retire on, in either case, let's say that real estate values have gone down through this. And I think it's reasonable to say that real estate values probably will go down through this. If I still have my income, then I can say, I can still pay my bills. Maybe I do need to push off my retirement a little bit. Maybe my retirement looks a little bit differently in this first couple of years, but I still have some income, and that income might be a little bit lower, but I can let this take care of itself a little bit over the next couple of years so that we return to a higher appreciation environment and the value recovers. I think fundamentally what's interesting about this environment is we haven't had a fundamental economic shift that happened prior to coronavirus that is creating this difficulty. It's this external force of coronavirus comes in, it's ruining everything, and you might be able to take coronavirus out, and we're just right back on that trajectory economically. I'm not sure that's the way it's going to go, but real estate can give you the opportunity to hold on and wait to see if that happens. So do you liquidate your stocks right now and go into real estate? That's really going to be a personal conversation, and it really comes down to your goals and your needs. I wouldn't take that idea off the table. I might be interested in still liquidating my stocks, even though they're down 25%, so that I would have cash available to me to buy real estate if there's a strong real estate opportunity. I'm also looking at the risk of still owning the stock market at $23,500 today. I think that sounds high. We're going to see earnings reports come out from companies over the next month or two, and they are going to be terrible. And the stock market is based on the earnings of a company and the multiple of that earnings, broadly speaking, okay? So we came out of an environment where if a company earned $100 a year, then the stock market would price it at 23, 24, 25 times that number in terms of what the value of the stock would be, all right? Well, if they're no longer making $100 a year, now they're making $10 a year, or in many cases they're losing $100 a year, well, then the value needs to change. And so we're going to see stocks come out with their new pricing and their quarterly earnings reports. They're going to be bad. And frankly, I'm surprised the stock market is as high as it is right now, because it's an indication of the value of the company today. But I don't understand the stock market. I don't pretend to. I'm sure my commentary is way off. I'll also say that if you're going to buy the stock market today and you're going to hold it for the long term, it's probably a great bet. You're not a stock picker. You're buying the S&P 500. You're holding it for 10 years. Let it be. That's probably a great bet. With my stock holdings, that's what I do. I buy it and I sit on it, and that's that. You know where I got that idea? A guy named Warren Buffett. He said, just buy the S&P 500 and forget about it. He's way smarter than me.
I think you're pretty smart. Ryan, is there a formula you think for, if I'm looking at real estate as my retirement income, is there a formula that I should be shooting for, a loan to value, a reserves in place? What should that look like if I want to retire on the real estate I own?
That's such a personal question. I think that when you're at retirement age, the biggest thing that you need to understand is how much income do you need to pay your bills and live a comfortable life. If you're not able to reasonably understand and state that number, then you can't go through the thought exercise of working backwards to how your real estate portfolio should be positioned. I do have a lot of folks in my life that have said, I don't want to have any debt in my real estate portfolio when I retire. And that might be a great response, because you're protecting against the downside. If you don't have any debt, it's very unlikely that you'll have big disruptions to your real estate. However, right now, even without debt, if you have fewer people paying their rents, you're still going to have less income. And I think that what would be key is that if you're close to retirement, having those cash reserves, I'm putting a higher emphasis on my rainy day fund and just my money that can be there for my living expenses for 6 months or 12 months or 24 months in case I don't have that income. So I'm looking at a higher value on my liquidity so that my annuity, which is my rental income, when it has ups and downs, I can smooth those ups and downs through my cash reserves. That's probably the way that I'd approach that question, but it's just a very personal question.
Let's go back to something really tactical, if you will, in the property management business. So when should we start considering incentives to our residents, discounts for paying on time, those types of things?
I think the first incentive that I might look at a little bit right now is how we're going to lease properties, and are we going to do anything for our new residents to encourage them to lease from us. And we're very strict that when somebody comes into our properties, that we require them to pay the first full month's rent and all of their security deposit on day one. Well, if they're renting a $1,500 property, that's $3,000 that they're bringing on day one. To us, the reason why we're so strict about it is that we want to know that they have real commitment on the property and that they're vested in it. But what are some of the other things that we might do to incent them to come into that property, to show them that we're part of their partnership? Are we going to put in a washer and dryer for them, which we might not usually do? Are we going to look at putting in a new appliance? Would we maybe do a gift card to Home Depot to say, hey, thanks for doing this and we appreciate it. And here's an opportunity for you to move in with a little something new in your life. So that's an incentive, and that is a cost that as an owner of real estate, I need to be cognizant of. Is that a cost that I'm willing to receive? Yes, it is, because it brings occupancy and collected rents and certainty. Now, on my existing residents, what other incentives? We've begun to discuss positive reward incentives for paying on time. I don't think we're at a point right now where I'm certain that that will have effectiveness. In many cases, the person that's going to pay and pay on time is going to do it no matter what. And a positive reward system for them is actually not the message that we need to give them. I know that we've talked in the past about incentives around how you care for a home and what it looks like when you move out and what happens when we do our annual inspections. The thing is that I want that to be the standard, the expected standard. I don't want to change and move the needle higher, that the new expected standard is that, oh, actually, you don't need to take a very good care of it. And if you do, I'm going to give you something for it. I'm telling my tenant on day one, it's my expectation that you pay your rent, you pay it on time, and you take good care of this home. And you can expect from me that I'm going to be the best landlord you ever met. When you have a maintenance need, I'm going to take care of it immediately. I'm not going to meddle in your affairs unnecessarily. I'm only going to reach out to you when there's real things that we want to touch base on, okay? And I'm going to be available to you when you're in difficult times. So that's a great message that sets the bar for what the expectation is. And sometimes incentives and rewards really change the psychology of that. So oftentimes I'm hesitant to implement those until I really understand what is that going to do to the psychology of the consumer and the implicit verbal and nonverbal, written and not written agreement that we have as partners in this transaction.
Ryan, a few questions have come across saying, you're really asking, I have parents right now who are struggling with what's it going to look like for them to either stay retired or retire on their original plan. Do you have any experience with that and insight that you can share?
I probably will take this in a different direction than the person asking it wants me to. We're in a moment in society and in life where it feels as though we can have all the answers all the time. We have information at our fingertips always. We have a better understanding of what the healthcare system can do for us and what our finances are going to look like than we ever have had in the history of humanity. All that is great, but it's teaching us something that isn't very great. It's teaching us this notion that we'll always have the answer. And right now we don't have the answer. And that's okay. It's really okay to sit on that and say, yep, I'm afraid, but I'm going to name my fear on this and I'm going to look at it. I'm going to lean into it a little bit. I'm going to accept it. I'm going to embrace the pain associated here. And by leaning into it, I actually derive a lot of strength from it. And I'm able to say, oh, you know what? It's okay if this happens. I'm not going to run away from it. You know, Tony sent out to us several months ago a little parable, or not even a parable, a little story about cows and buffalo. When the storm comes, a herd of cattle run away from the storm. And by doing that, by running away from the storm, they actually give their experience in the storm longer because they're running with it, okay? Atlas wants to be the buffalo. The buffalo says, the storm is coming. It's going to be painful, and I'm afraid. I'm going to run damn into that storm. And that's the way that I look at this. Yeah, it's going to be painful. If you're planning on your retirement from your $30,000 stock account, $30,000 Dow, and or from your real estate, and we're going to have to adapt and be nimble. And I want to lean into that. And that's the piece of this that with Atlas, I think that we really derive great strength in leaning into it, and we find the opportunity. And it might mean that I have to go to work. It might mean that I have to work with my tenants and I see pain there, but I'm going to position myself to have a little bit of that pain so I can get to the long term. And I think a lot of people will position themselves to run away from that pain, and their long term is not going to be as pleasant.
Ryan, I've gotten a few questions about how's the Atlas team doing? And we appreciate that question and the intent behind it. So to those of you that have asked, thank you. But Ryan, comment on how's the team doing?
I hope I'm not speaking in a little vortex on this, because it would be easy for me to do so. I'm a biased guy, but you know, Atlas is a big part of my life. I think that the Atlas team is doing amazing. I think that our psyche is incredibly high emotionally. I think that we found unique ways to still maintain contact with one another and maintain our robust community and culture. I know that everybody's having pain. I'm having pain. I've had moments of deep sorrow through this, and I've tried to really settle into those moments, and I hope that our team has as well. But I think generally speaking, we're waking up in the morning and we're saying we have purpose. Our purpose is meaningful. We're helping people to have a place to live. We're helping people to realize their investment and their savings needs. This is a real problem that we can go out and execute on a daily basis. And that purpose leads to fulfillment. And we have a shared fulfillment through our culture and our community. So I think that we're really strong there. And if we're not, if there are any Atlas team members on the call, I welcome direct feedback on that, because we want to support you on it. Please, please. This is a direct solicitation to tell me. And I know that there's challenge. I know that there's a lot of pain, and that's okay to accept that and to welcome it.
That's great. Ryan, we don't have any other questions in the queue right now. So we've got an opportunity for some closing thoughts from Ryan, and we'll conclude our webinar here in just a couple minutes.
Closing thoughts. I mean, I don't know that I can be that bold. I'm just opining a little bit on real estate. I think my closing thought will be this, and I've said this a few times. If the only prayer you ever say is thank you, that shall suffice.
Well, thank you for that. Thank you to everyone who joined us today. We do intend to continue to do webinars over the weeks ahead. This is definitely a situation that's evolving quickly, and we want to share as much information as we can. And we certainly enjoy opining from time to time. So watch for invites from us in the future. The recording of this will be available on our YouTube page, and we'll send that out as well. Thanks so much for joining us. Happy Good Friday to all of you. Have a fantastic weekend.